leaders from business advisory, tax, risk management, property, superannuation and investments, employment and HR give their insight into the current economic and financial landscape that impact small to medium-sized businesses all around Australia during this pandemic and beyond. My name is Lisa Garrido, and I will be your host this morning, introducing a panel of small business advisors and leaders in their area of expertise. I should also provide the following general warning that the views and opinions shared on this webinar are designed to be general information only and are not designed to be taken as specific advice for your personal or specific needs. Please feel free to reach out to any of us panel members at the end of the webinar on Facebook or LinkedIn to get advice that meet your specific requirements. Feel free to reach out to us. I now welcome today Adam Lyle from the Biz Doctors.
Hello, Lisa, and happy International Women's Day for you. Thank you for hosting today. You're an amazing woman.
Thank you. Thank you so much. Ian McLaughlin from Imperium Accounting and Tax.
Thanks, Lisa. Happy International Women's Day and welcome to all our viewers today.
Thank you. Sam Qureshi from Moneyclip Group.
Thank you, Lisa. I echo the sentiment that's already been told in this fine webinar.
And yours truly, Lisa Garrido, and welcome to all our women viewing today's webinar. So Adam, I thought we'd start up with you. What's your update, please, for the week?
Economy. What the hell is going on? I love the fact that the Australian economy is starting to really kick. I really like that. I'm not the pessimist that everyone thinks I am, but I'm also a realist. That's probably where I'm going to be coming to today. It is really good that we've had a huge bump in GDP growth. It's fantastic. But if you have a growth path, but you still haven't met where you were pre-COVID, that's fine, but we haven't felt all of the pain out of COVID yet. And I want to explain that today. I'm going to break that down. And so my point is, and I've said this before, that I thought that the announcement from the Treasurer a few months ago that we're out of the recession was premature. And I want to explain what I mean by that. So the Reserve Bank of Australia have come out this week and said, fantastic, great numbers, here we go, economy's going gangbusters, etc., etc. Now, Sam and myself and even Ian have said we believe that there is a bit of a two-speed economy going on. And we do believe that there are sectors within the Australian economy that are going very well, and there are other sectors that are not going so well. The good thing for the economy is that the things that are going well are actually carrying the rest of the economy to a certain extent. Now, you know, you don't need to be a rocket scientist to understand that tourism and hospitality are still suffering, okay? Airlines are not back to their full operating capacity. Tourism is nowhere in terms of what it used to be. Inbound tourists are nowhere near where they should be, and that's probably not going to change for about a year. Domestic tourism has certainly lifted, which is great, but overall our consumer confidence, which drives normal household spending, is up, but our business confidence is down. And until they come back to about parity, we do have an issue. Now, I just said before that the growth that we've had in this last quarter is really good, but we haven't overtaken where we were pre-COVID. And here's the issue. For SME, our viewers, our bread and butter people that are watching us today, do understand these things. They do understand that they have been, thankfully, very well supported by the governments across the country, not just the federal government, with the various grants, JobKeeper, business cash boost, all that sort of stuff has been going on. Those things come to an end. JobKeeper isn't being extended after 31 March. It's all over. So you have to survive on your own. You have to swim on your own. Sorry, I just had a little fly trying to attack me. Banks are now in the position where they probably will come to you and say, hey, we like you, we want to keep you, but what are you doing about your loan? We gave you maybe 12 months off. We gave you 6 months off. And we can see that you're getting some revenues back into your business because they monitor your accounts. If you don't understand that, there's something wrong. And they're probably going to say to you, now we want to see you starting to repay the loan that we gave you some freedom for. Your landlord is going to say to you, you know what, we carried that bridge together, we held hands, that's fantastic, but I've got a year's worth of rent that I'm now in arrears for. What are you doing about that? And if you're not back, let's put it back into SME perspective. If you're not back to parity yourself pre-COVID and you're dragging the chain trying to get back to break-even point, how do you pay your rent now plus a repayment of the arrears? Okay? And the final thing is that ultimately your creditors, the people that are supplying you, are also hurting. And if you haven't been able to pay, let's say, 6 months worth of invoices, which you had protection for, you didn't have to worry about anyone saying to you, oh, you're insolvent trading and all that sort of stuff. But ultimately, they're going to start saying, hey, we want to supply you, but what's going on with that bill? What's happening with it? Can you help us out? How about this? We'll put you on COD for the next 3 months until you get yourself back on your feet. And if you don't have the cash to pay for the suppliers today, because you don't have any JobKeeper money coming in after 31 March, you've got a cash flow hole. So I'm hopeful that that has really helped you understand the dilemma that the Australian economy is going to be in. Because after 31 March, there are going to be pain points within the economy. Here's why I think it is going to be an issue. The Australian Charitable Foundations Council of Australia have already submitted to the government that they expect the demand for charitable causes is going to increase by 181%. They're already seeing it. People are becoming homeless. People are not being able to pay their rent. They're starting to lose, the people that have lost their jobs and haven't been able to regain their jobs back or haven't been able to get a new job are entering into long-term unemployment. So we are seeing some pain already, and I don't think I need to ramble on anymore. I hope that's been really clear and helpful to our viewers.
Thank you, Adam. There's a lot of considerations there for all our viewers. They definitely need to reach out to you then in the next week or so. So please reach out to Adam in terms of some solutions if you feel that you are in that situation. Sam, over to you now for updates on interest rates, property, and the markets and superannuation.
Okay, great. Thank you, Lisa. So from a interest rate perspective, it was relatively quite weak. Not much happened there. Bond rates continue to be monitored by RBA at the moment. They did spike a little while ago, and they were still a little bit up and down last week. So bond rates are very important because it's the flow and effect of the bond rates that affects the fixed rates that the banks offer to mortgage holders. So obviously fixed rates are quite cheap right now, and some even blame the current housing boom because of that as one of the reasons. So certainly we had a very strong auction results again across Australia, although slightly smaller scale in Victoria and South Australia who are having a public holiday. New South Wales continue to be above that 90%. And the anecdotal stories that I'm hearing from many people is that basically that FOMO is well and truly is in place. And it's as bad as when people were chasing toilet papers in the middle of the pandemic. So, I mean, that's a bit of a worry, and I wouldn't be surprised if it gets to a point that RBA will need to step in and cool the house prices as the unintended consequence of this current cheaper rate to get us beyond the pandemic has now given rise to escalating property prices, making it far less affordable, and a lot more speculation in the market as well, which is obviously not what the RBA really wanted to do at all. As alluded to, we have a guest speaker next week with a history in the real estate market. And it'll be great for everyone to tune in next week to hear the great insights that's going to be coming out about the real estate going forward. Now, going on to the markets, they certainly had a recovery last week, though it lost a little bit of steam towards the end of the week. Nonetheless, it was up about 0.5% compared to a week before. And we've already seen a very strong rebound today on the ASX because of the strong rebound in US closed last Friday. Now, of course, GDP numbers was talked about just before, and obviously they have been encouraging. And Adam has touched base on that, so I won't cover off any more on that at this point. Reporting season is almost done, and overall there were more positive than negatives at this point in time. Post-pandemic recovery has been in full swing now. Of course, not all businesses are back to pre-pandemic, but definitely making some progress. Now, it doesn't mean that everyone's doing well, though, by the way. According to Goldman Sachs, 59% of the firms that reported they beat their forecast profit versus last half. But of course, that was a smaller base to report from as well. So I guess what we see in July-August period for this particular half that we're in is probably a better indication of how things are really traveling. Now, some pointers that came out of all these recent reporting season, definitely the profits have been up for many. Banks and miners were the standout winners by the looks of it. Travel, property and energy stocks were the COVID losers in particular. Retail, healthcare, consumer staples and automobiles were the COVID winners out of it. Any company that has high valuation will now be under pressure as well. So because obviously they've performed highly in the COVID period, and so they need to continue to deliver in order for them to have that high valuation continue. And of course, technology companies were the ones that had the biggest increase in that period, and obviously they'll be under the most amount of pressure to get that to continue to perform. Now, Adam mentioned something about confidence numbers before. So this week we'll have the new business and consumer confidence come out, and that will tell us how business and consumers feel about spending overall. And I guess that will be a real telltale of how things are traveling out of the Christmas period. RBA Governor Philip Lowe will also give a speech on monetary policy tomorrow, and that's going to be really a critical speech. So we'll all wait with bated breath as to what's going to come out of his mouth, and really the commentary that's going to go around forward-looking of how things are going to play out, and of course whether they make any comments about the property market and interest rates. And I certainly look forward to our guest speaker coming on next week. And with that, back to you, Lisa.
Always informative, Sam, and looking forward to next week's update then with all the commentary and observations coming from this week. Ian, over to you.
Thanks very much, Lisa. So just a couple of things that I want to touch on today. Firstly, as previously mentioned at the top of the webinar, we are at the 8th of March. So that means that businesses have only 6 days left to make their February JobKeeper declarations by the 14th of March. Now, if you haven't yet lodged your December 2020 BAS, so the ATO can determine that you do satisfy the turnover requirements, you still have the option of manually declaring this via the ATO portal. That means even if you haven't lodged a declaration for January, but you still qualify, meaning that your turnover was 30% below when you compare your December 2020 numbers to your December 2019 numbers, you still can make claims for the payments for February and March, provided that you paid the workers the required amounts. Secondly, I just want to reiterate today some key dates. So the December 2020 BASs were due for lodgement and payment on the 2nd of March. So it's really important that if you haven't yet lodged your BAS, that you do so. Now, if you can't make the payment, it is really important to keep the lines of communication open with the ATO and enter into a payment arrangement. Now, the ATO is really good and generous at gifting the payment arrangements, and any debt which is under $100,000 can be done online via the tax or BAS agent portal with a simple email to the ATO. So that's really important to just, even if people don't, the ATO doesn't want people not lodging because they have the fear that they can't pay these amounts. Get the BASs lodged, keep your lodgements up to date, and if you need to, then enter into a payment arrangement. Thirdly, I just wanted to touch on something that was fairly interesting that's come out over the weekend. So the Australian Small Business Ombudsman latest research paper outlines 25 recommendations geared towards creating a much better tax environment for small business owners. So two of these in particular that I wanted to bring to note. Firstly, scrapping the fringe benefits tax regime. And secondly, taxing GST at the point of sale, which is really interesting. So the FBT regime and the relevance of it has been up for discussion and debate by various bodies for some years now. And the recommendation from the Ombudsman is to introduce reforms that would see defined work benefits exempt and choice benefits, so ones that employees choose to enter into, be taxed as income. Now, part of the reason is because the FBT regime is fairly complex, but it also, from a compliance point of view, it is quite arduous to manage from a small business point of view. And then also the compliance costs involved in getting this done as well are quite high. So that's going to be a really interesting one. So I wait to see what happens with that one. Now, the next one is the other recommendation from the Ombudsman is to give small businesses the option to remit GST to the ATO at the point of sale instead of on your monthly or quarterly BAS. Now, this would ease the cash flow burden because a lot of businesses get themselves into the problem where they collect the money and then 3 months later, when they have to lodge their BAS, they're scrounging for it because they haven't properly put it away. So this would ease that cash flow burden. I kind of like this. I'd imagine that there would be a fair bit involved in getting this set up. Now, the business would then still lodge their BAS as per normal, but you wouldn't be liable to pay the amount with the GST on sales because you would have already remitted this to the ATO. Now, when you think about this, it's going to work well from a cash flow perspective from a second point of view as well, because you will then be, when you do your BAS, you will then be claiming back the credits on your purchases for GST. So I think there's kind of like two really good cash flow techniques in this, and it'll be interesting to see if the Ombudsman can get this one through. Obviously, you know, these things do take some time, but once again, I think that would be really good for small business. So I will keep you updated with any more of those recommendations and where they get to. So thanks very much, Lisa. That's it from me today.
Thanks, Ian. Again, very interesting considerations and points of view. I'm looking forward to any updates on that. Maybe next week you can highlight a few other recommendations out of the 20 points you just mentioned. Thanks for that. Now I'd like to go over to employment and HR. For our viewers who have been following us, as you know, I've been discussing the changes in annualized salaries and the new rules in the Modern Award in the last 2 weeks, and wanting to emphasize that as employers, you should take steps to ensure that your payroll system and record keeping procedures are up to date. It's now the 8th of March. These changes came effect in the 1st of March. So just as a forewarning, if you fail to comply with the terms of the Modern Award and the annualized wage clauses, you could face the risk of underpayment claims and, of course, severe penalties for breaches in the Modern Award. So again, it take steps to ensure you are compliant with these salary provisions. Last week, I talked about the first option that we all have as employers, and that is really, and that is really to choose to annualize the wage over a 12-month period and pay a set amount in satisfaction of the Modern Award. And that includes the wage, the allowances, any overtime and penalty rates, and leave loading. And secondly, that you need to make sure that you advise your employee via an agreement, and that the agreement should include the annual wage that needs to be paid, which award entitlements are included in this annual wage, how it is to be calculated, including any assumptions under the calculation, the maximum, or what they call the outer limit number of penalty hours and overtime hours the employee can work in a given pay period, and any added incentives for that individual. Bear in mind that added incentives like free tickets, gifts, etc., cannot be used to determine an employee salary. So therefore, for those that are going to choose to take option 1, you must keep a record of the employee's start and finish times, as well as unpaid breaks, and keep a record of that, and it needs to be signed by the employee at the end of every pay cycle. So again, these documents are so vital because you need to do an annual reconciliation, which takes place every 12 months, where you need to look at what was paid to the employee and what needed to be paid. So the second option I'd actually want to raise is option 2, which I'd like to share the screen on at the moment. Let me just share screen now, if I may, Ian. Here we go. So this is option 2 for our viewers. This is for a lot of most of my clients actually that have what you call common law contracts. Can you guys see this at the moment? Yeah? Okay, good. So the option 2 is where there's an arrangement recorded in the employment contract that sets off or buys out the monetary entitlements like loadings, allowances, penalty rates, and overtime rates owing under the modern award. I would suspect that most of my clients fall under this particular section or option. It does not extinguish the employer's obligations to pay the monetary entitlements as per the awards. And of course, these are still in force and remain payable. However, in the employment contract or annual salary, as you call it, the salary basically pays or takes offsets what you call the annualized salary in the modern award. So basically, the employers that continue to rely on common law set-off clauses are allowed to do that as long as they comply with some obligations in the modern award. And what are these requirements? That the entitlements under the award need to be paid for. They must satisfy the award payment obligations for each entitlement, and that the employment contracts must include these set-off clauses. So your contracts need to be carefully drafted to identify the award obligations that are being paid for in the annualized salary. So there must be close correlation between the contractual payment in the contract and the award obligation. So please, ladies and gentlemen in business, please make sure that you seek advice from an HR consultant or an employment lawyer to review your current contracts. Again, the obligation is that you keep your records for 7 years, and the records must specify the rate of remuneration paid and the gross and net amounts paid. It must also set out any incentive payments that you've given your employees, any bonuses, any loadings and penalties or entitlements that are payable. A record of the overtime must be retained, whether you're paying overtime or not. Again, a record of overtime must be retained, even if you're paying a salary which sets off overtime. The implication, if you don't keep these records, is that if there's a case or a complaint, the presumption that the allegation of modern award breaches is made, unless you can prove as an employer that you haven't breached the obligation. So what can we do now if you decide as an employer to use your common law employment contract to offset the annualized wage changes? Review the common law contracts, look at options to ease the administration burden of actually having this arrangement, and promote a flexible working environment that is free from clock watching, which would be, I would suspect, the tendency of these particular changes under the modern award. So again, there's a lot to digest. I will give them in snippets because I believe small bits of information meaningfully presented is more relevant than the whole kit and caboodle. So that's it from me. Do we have any questions from the panelists before we move on? Anyone wants to unmute?
I don't have any questions, but I think maybe Ian and I and Sam should get some camp chairs and sit outside the RBA for these discussions this week. I can't wait. I'm looking forward to it.
Oh,
There certainly is a lot of
definitely.
yeah,
Yeah.
there's a lot of new information that's going to come out this week that's you know, is going to positive or negative, and is going to have that, you know, that seesaw effect in the markets. So yeah, it'll be very interesting to see how it all plays out.
And as you guys know, anything that happens in the market with business confidence and consumer confidence affects anything related to people management and people retention and people engagement and talent searches. So this all is like a cyclical effect across all businesses. So yes, there's a lot to talk about, but in the line of International Women's Day, the theme of that, next week, ladies and gentlemen, we have a special guest. And we would urge you to invite any of your other members in your network to attend our webinar next week. We have Anna Porter from Suburbanite. She's the founding principal and director. Suburbanite are a one-stop shop for property investment buyers or prospects. And she will be talking about the Australian property market and the risks and rewards in the market at the moment. So please watch out for that. And we're looking forward to having you join us next week. But before we close the meeting today or the webinar today, I'd like to give a quote from someone unknown, very pertinent today. So here's to strong women. May we know them. May we be them. May we raise them. Thank you, everybody, for listening to Business Insights on Monday at middays, and have a good afternoon.